All right, so this is financial analysis comparing MPW and Well. Um, just a few quick things. So total revenues is pretty straightforward. And this is using the last 3 years of data, so 21, 20, and 19. Expenses, I did not include depreciation, amortization. I also did not include interest expense because I listed that separately. But everything else is there. So maintenance on buildings, just general administrative expenses are there. Um, it was interesting that they did not break out those administrative expenses for Welltower, but we just have to assume that they're in there. Let's see, interest, total assets. Usually I'll take out goodwill when looking at assets, but I left goodwill in there. Whether or not that's going to make a huge difference in comparison between the companies, I don't know. I mean, Welltower is the larger of the two. So maybe they have more goodwill because they've, acquired more companies. I don't know. But again, so goodwill is in there. Goodwill, just so you understand, is what gets accounted for when you purchase something for more than what it's worth. So if there's a company out there that's worth, $10,000 on the balance sheet and you purchase it for 15,000, well then 5,000 of that is considered goodwill, and that makes it on to the books of the purchasing company, and then that goodwill is amortized over 15 years. And so again, typically I'll take that out, but I left it in for this particular purpose. See, total liabilities, pretty straightforward. A lot of that is going to be mortgage loans and just general loans, nothing too fancy there. Net income, again, exactly what it sounds like. The expense divided by revenue, that's just looking at, literally, what percentage of the total revenue coming in is going out in expenses, okay? Interest is how much interest that they're paying on their loans compared to how much revenue they're bringing in from those loans. And then revenue in assets is how much money they're making compared to the amount of assets that they have. And then we have liability is, how much of their assets are being funded by their liability. Of course, we don't want a company that has $100 in loans, but they only own $50 worth of stuff. Like that's ridiculous. Why would you have a loan for $100 but you only own $50? So you definitely want to have that number as low as possible. You don't want to have as many liabilities as you have assets. And then we have net profit or net income as a percentage of revenue. So let's take a look at this stuff. What you see here in yellow is comparison from the year before, okay? And so we can see here in 2021, total revenues increased by 46% for MPW. In 2020, there's an increase of 8% compared to Welltower, which fell 10%, and then they had a roughly 8% increase in 2020. So just right away, MPW bringing in a lot more revenue, whereas Welltower's revenue has fallen. I did not do an earnings calculation on this thing. And I don't really think there's a need, right? Because if we know that the revenue has come down, then typically earnings are going to come down because shares are going to stay about the same. And so when your earnings are lower and your price stays the same or your price increases, that increases your PE ratio, and we did see that earlier. And so with MPW's revenue increasing by so much, clearly their earnings increased as well, and that's what would bring their PE ratio down. All right, so expenses. This number we want to see come down. I'll tell you the biggest factor for this particular industry is going to be what happens when you have to either get rid of a property or you have to spend so much money to repair a property. Okay, and that's called asset impairment. Typically, what that means is, like, let's say you buy a building for like $1 million, and then you basically take a look at it a year later, and you're like, wow, man, this thing is not really worth $1 million. It's really only worth about 700,000. In that case, you now have asset impairment of $300,000, and so that's what you see here. 30% 2021 is the increase. 30% 2020 is the increase for MPW. For Welltower, you see there's a huge jump up of almost 300% in 2021. But then we have a pretty big drop in 2020 of almost 80%. There's a steady increase on MPW side, but it doesn't make up for what we see here in expenses for Welltower. Whether or not that is an outlier, I don't know. Again, this is 3 years worth of data. We can go back further, but 3 years is usually where I stay with this stuff. All right, interest expense. Again, this is the amount of interest that they're paying on their loans. What we want to see is we want to see companies that are figuring out, restructuring their debt, figuring out ways to get loans for a cheaper rate and pay less interest, right? So that's what we want to see. We see that there was an increase in interest 2021 for MPW, a small increase in 2020. For Welltower, it has year over year declined. So that's really good. We like to see that. Well, I'll just go down the list here. So assets, again, this is everything that they own, including any sort of loans that they've made to people. This is going to include just everything that they own. I just took a straight number from the balance sheet. We do like to see assets increase, though, right? If they're decreasing, that lets us know that the businesses may be selling some stuff or getting rid of some stuff. The company is becoming smaller, which is not necessarily a bad thing. Just kind of lets us know what the company is doing. It also gives us something to compare against other things here. So clearly, Welltower's assets are much, much larger. Like I said, Welltower's the biggest in the world. Number one. So that's that. But it is important to note, though, that MPW increased their assets 16% in 2021. Looks like they increased it almost 63%, which is a crazy number in 2020. As Welltower increased 10, dropped 2. I have to imagine that this 2020 increase is going to be due to some sort of acquisition. They probably purchased another company and took on their assets. We do see here that the liabilities, which again are going to be loans that they take out to purchase assets and do these things, did increase as well in 2021. The liabilities actually increased more than what the assets did. It doesn't really give me a lot of pause. But it is something to think about. So let's take a look. So for Welltower, liabilities are decreasing. Liabilities increased 73%. So again, we have that big increase of 63%, but then the liabilities increased 73% in 2020 for MPW versus 14% for Welltower. But it's important to note that Welltower, again, increased their assets 10%, liability 14%. So it's still more than what the asset was. In 2021, liabilities decreased 7%, assets only 2%. So that's really good. So far, not really seeing a whole lot other than the fact that it appears that MPW is managing everything just a little bit better. Welltower is definitely bringing down their debt, which is a good thing, right? All right, net income. So again, this is what the income is after all the expenses, after paying taxes, after everything. It increased 14% in 2021 for MPW, whereas it fell 20% for Welltower. And again, that goes back to the story concerning the PE ratio. In 2020, however, net income fell 63%, which is huge. And for Welltower, it increased 60%. So this, for me, is basically a wash, right? So in 2020, you have MPW and Welltower, basically opposite each other as far as net income. And then the same thing happens in 2021. Difference being, though, that MPW seems to lose just a bit more than Welltower, 63 versus, and then 14 versus 21. All right, so these are our ratios. The expense is a lot bigger for MPW, which is actually a decrease in 2021. Welltower had a huge increase, and then we see this huge decrease. So this expense, like I said before, again, asset impairment, maintenance, getting rid of buildings and things of that nature. So clearly, this kind of stuff is going to vary greatly, obviously, from year to year. So there's really not a whole lot that we can tell looking at that, honestly. But what is important for me anyway is that the expense is much higher. So on average, MPW is just spending more money, right? They're just spending more money than what Welltower is. And I think sometimes that's indicative of a smaller company. You know what I mean? Larger companies tend to get better deals. They're buying things in bulk, what have you. Interest expense. Now I'm going to say, this is straight up management, right? I mean, again, bigger companies tend to get better deals, but this is a huge difference, right? So Welltower is spending, not even 1% of their revenue on interest, whereas MPW is spending 26%. So that means for every dollar that they bring in, 25 cents of it is going directly to interest. And that interest is just money that's being thrown away. You're spending 25 cents to borrow money, and you use that money to make money, right? So that's not a great thing. Welltower definitely seems like the better deal in that case. And we see here the number is consistent for 2020 as well, 27% compared to Welltower's, like I said, less than 1%. And it's continually dropping, so that's good. All right, so how much revenue are they bringing in compared to their assets? And it looks like revenue is 7% of assets versus 14% for Welltower. So again, we're just looking at a better run company. Now, Welltower did increase 25%, so that's pretty good year over year. It was, almost 6% last year, and Welltower was at 15%. And let's see here, did they drop assets? And they dropped assets a little bit, but yeah, I don't know if it's enough to make up that 7%. But anyway, again, we're just looking at a better run company from Welltower. Um, Much more revenue for every dollar of asset earned, and that goes to return on assets. We looked at that in our surface level analysis, and you can see here there's a huge difference, and that's why it's important to do these deep dives on this stuff, because you really get a chance to see what's really going on. And man, you know, 14% means that for every dollar that they own, right? That dollar that they own is bringing in an extra roughly 14 cents, versus MPW's 7. So again, it's just management. We're talking about a better run company. All right, liability over assets. Again, the smaller the number, the better. We see that we had an increase in 2021 for MPW, increase in 2020 for MPW, increase for Welltower as well in 2020, but then another drop. And 48 2020 versus 49. I'm gonna call that a wash, but again, Welltower is just a little better in that regard. And what that means is that they have more assets than liabilities. They own more than what they owe, and that's what you want to see. That's what you want from a company. That's the kind of person that you want to invest in. That's the kind of company that you want to invest in. All right. Last but not least, net income divided by revenue, and so this comes down to, at the end of the day, after everything is done, right? How much of that dollar that you brought in, how much of it are you keeping? Okay. And 2021, 34% of every dollar the MPW was able to keep. That's really good compared to 22% for Welltower. And so that definitely goes into, again, how Welltower accounts for their expenses. Clearly, there's some expenses in there that weren't broken down. I'm sure if I went into the earnings notes, I'll be able to figure out exactly what expenses are inside of what typically are labeled as other expenses on the income statement, which I've always hated that. But I understand how it happens and why it happens. A lot of it has to do with image, right? Because remember, these earnings reports are being seen by, thousands, if not millions of people. Well, I'll say thousands. It's being seen by thousands of people. It's public record. It's going to be around for a very long time. And I have never put together an earnings report myself, but I have helped do it, and I've been close to those who have done it for public companies. And, it can be stressful. It can definitely be a stressful time because, you definitely want the company to look good. You know what I mean? That the primary investors are going to be looking at this stuff. That the board is going to be looking at this stuff, and so you want to be thoughtful and also careful about how things are reported, right? And clearly for Welltower, listen, I don't know the inside story, but MPW clearly is beating out Welltower fairly handily. 34 versus 22 is almost double, almost. You know, that's a big deal. And so now the script is flipped, and it looks like MPW is a better run company because they're keeping more of their money. Now, both of these guys had a decrease in 2021. MPW had another decrease in 2020. Welltower was increased. But again, man, we're looking at 44% versus 25%. So, again, looking at interest expense, looking at those loans, it appears that Welltower is the better managed company. But when you get to the bottom line, right, when you get to that net income, which is earnings, right, the numbers don't lie. You know what I mean? MPW is keeping more of their money, and that net income is what shareholders are allowed to have. You know what I mean? And so that's what we want. Now, I did pull the quarterlies, but I didn't go 9 months. I only did 6 months. And the reason being is because when you're doing quarterly, especially after looking at the last 3 years, you're not going to get much more detail from going back further. But I did want to pull the most recent numbers just to see kind of what they look like. And so here we see revenues increased quarter on quarter. Welltower, we see a decrease. Again, it goes back to the PE ratio, which points me even further to MPW. Expenses increased for MPW, decreased for Welltower. Interest increased for MPW, decreased for Welltower. So what this means to me, because I've seen this so many times already. It's the same motif, right? MPW has a real problem with their interest expense, which means they have a real problem with financing. I'm really curious to know what the heck is going on there. MPW and Welltower are pretty much in the same industry. The way that they do their leases definitely is a bit different. But my goodness, man, going out and borrowing money is the same for pretty much everybody. You know what I mean? And they're just not getting it done in that space. Also, too, I do want to mention I did check, and a very small portion of their portfolio is based in those other countries. Most of their properties are in the United States. So that's not something that, I don't think we need to really worry about. But it's interesting, though, because typically in Europe, you get a better rate on your loans. So I don't know what's going on with these guys. That's definitely something that they'll have to make better. Maybe everyone else is having the same problem, and Welltower's just maybe because of their size or something, they're just doing way better than everyone else. I don't know. It's interesting. Something I definitely want to take a look at. Total assets, again, increase for MPW, which means these guys are growing. They are buying up properties. They are acquiring other companies. We've seen that over and over. That's pretty cool, which may be why they're paying so much on interest and loans. I'll go back and look at the liability increase. Same thing here, 12% versus 4%. So they're taking on a lot more debt. Net income jumped up 100% versus a drop of 76% for Welltower. Again, MPW just seems to be killing it. Expenses are 11% of revenue versus 65% of revenue for Welltower. That's a huge difference. Interest 23% versus 11. Before I talked about that. Um, Revenue 1% versus 3. I'm gonna call that a wash. Looks like we had an increase in most recently, and a drop for Welltower. Um, Same thing with liability and assets. Um, and again, huge difference in net revenue. So that is why Welltower is expensive. Now, I've talked about this before, and I'll end with this. Again, the market is made up of people. You know, you can argue that there's a lot of algorithms and machines and stuff like that, trading on equations. But at the end of the day, even those things are programmed by people, right? So the market is made up of people, and you market psychology gets really interesting as to why someone will put their money in a certain company that's obviously not doing as well as another company. You know what I mean? Just you can't get past it. Like I said before, MPW has a problem. Um, and I don't like seeing that, but bottom line is that an MPW is doing way they increase their revenue every time, and they increase their revenue over and over. So they've taken on a bunch of debt. They've increased their assets, but then they're bringing in much more revenue. And bottom line, they're keeping more of the revenue that they're bringing in compared to Welltower. Okay, so at this point, without comparing any other companies in the industry to see what their interest expense is, and I may still do that because that's something I can do pretty easy on Yahoo Finance or something like that, just to see what their interest expenses are, to see if maybe Welltower is just an outlier and just doing just way better than everyone else. But it's definitely something I want to keep my eye on. But at this point, though, I have to say that MPW is definitely a better investment. Whether or not the market will agree with me on that, I don't know. I mean, clearly, the market has been putting way more money into Welltower, which is why the PE ratio is as high as it is. We saw that huge price jump from like 50 to $80 a share. So yeah, again, it's one of those things, right? So clearly MPW is doing better. Clearly they're making more money. Dividend is better. You know what I mean? But the market likes Welltower. Maybe because they're number one. Maybe because they're the biggest. Do we make our trading decisions, our investment decisions, based on what we think everyone will do? I mean, yeah, part of investing is that, you know, they call it going against the market, right? And, it's, you have to know when to hold them and know when to fold them, right? Because like I said before, you can be right. The numbers can point you in the right direction, but that doesn't mean that the market is going to agree with you. And when the market does not agree with you, you lose money the way it works. You can forget the numbers, you can forget your opinion, you can forget the facts, you can forget everything and just say, hey, the market says this is right, then this is right, and you can go that way. So, that's also a thing. But in this case, though, definitely going to go with the, I would say, lesser known option of medical properties trust. And just keep our eye on it. Again, like I said, I'm definitely going to take a look at the interest expense of some other companies, and maybe even do a little bit of digging to see if I can come up with something as to why they're having this problem with financing. So anyway, that's it. Medical property trust versus the Welltower.